Yes, there we go.
Good morning. Good morning. Wow. Well, I am extremely impressed by this call, and I think your listeners are very fortunate to be able to access this level of insights because often on our side of the table, on the institutional fund management side, we do worry about how much access to this kind of information investors are getting. So thank you very much for that introduction and extremely thorough and insightful introduction there by all of you so far. I hope I can keep this going with my slides, and I'm not here to sell anything. I'm just here to help explore, and let's have that dialogue, and let's try to get closer to what the truth in what is a pretty uncertain time. So just to lay out what we do, and I'm going to be completely candid that it hasn't been the process that's been flavour of the month for the last 3 or 4 years as bond yields have been collapsing, but that it's coming into its own in this environment. So I'll just sort of talk it through. So the investment approach is, as Andrew's explained, it's looking for companies which are not valued for the positive fundamentals we see. Now, clearly, bond yields have been driving up valuations among quality growth stocks and tech stocks, and that duration argument that Andrew talked about, that's been absolutely critical. So companies that generate a lot of their earnings or revenues 10 years out have been valued at very high valuations simply because the discount rate's been pretty much zero. So that's been a really, really key headwind for this strategy. Now, cash flows here and now are important. And what's interesting is they become more important when the discount rate goes up. Now, all of this is basics, and I'm sure your listeners will know all of this, but it's worth reiterating that actually the cash flows that steady traditional companies from old economy sectors are producing right now are now more highly valued than they were 3 months ago or 6 months ago or 12 months ago. And that's because actually, if we leave aside the geopolitical situation, the discount rate going up is, I would say, the key news flow in stock markets globally on a 6-month view. And sure, in this particular period, there's a lot of sector by sector analysis that needs to be done in relation to the geopolitics, but it's worth saying that throws up opportunities, because what that means is that investors lose sight of those fundamentals. And actually, to me, a company that produces lots of cash, valued on a low valuation or a high free cash flow yield or a high dividend yield, that is just what we should be looking for now. And I put my hands up and say, look, the last 3 years, that's not what the stock market's wanted. But right now, and I think for some years, actually, I think as inflation takes hold, it is what people will want. Now, we are index agnostic. And again, that can have its pitfalls, because being index agnostic means we treat every company as if it's an equally weighted member of the index. So we don't look at a big company and say, we need to own that because it's a big index constituent. And we don't worry about not owning large index constituents. Now, in a year like this, you will well know, all of you, that actually the FTSE 100 is doing a whole lot better than the FTSE 250. FTSE 100 is up by, well, until this week was actually up, believe it or not, FTSE 100 in total return terms. Now it's down a few percent, but the FTSE 250 is down about 14 or 15% yesterday. So this gap is enormous. Now that's a headwind, but it's not one that's insurmountable. And we think over time, there's a lot more growth in those small and mid-cap companies. So actually, if you're looking now for opportunities, it's worth keeping an open mind about these smaller and mid-sized companies. So if we move on, James, thanks very much. So this scatter diagram on the left, it's just to give you enough flavour of, this is all of my holdings in my portfolio. There's just under 70 stocks in the portfolio, and you can see that the market cap ranges from very small, down at about 100 million, all the way up to over 50 billion. And you can see that actually there's no correlation really between dividend yield and market cap. We can access dividends right across the UK market, which is great. So and actually a lot of the time because there isn't much research coverage on the sell side, on the brokers don't tend to, I mean, sometimes those stocks down on the left in terms of market cap, they will be covered by maybe 2-3 analysts. So, and in a market like this, I'm looking at a sea of red today on the screen. What will happen is that people will be putting on program trades, and they won't be asking questions about what companies' prospects are on a 2 to 3 year view. There'll be asset allocation shifts out of equities, and during this period of turmoil, as uncomfortable as it is, there will be stocks that are mispriced. So that's why it's important to keep monitoring all these small and mid-cap stocks, and not to be too dismayed, and not to say, well, I'm never investing in that part of the market ever again, because otherwise what you find is you're always chasing your tail. On the right hand side, you can see that that actually the bars show you we don't really adhere to these indices. So as you know, FTSE 100 is 80% of the FTSE all share, and we're about 40 something. So FTSE 250, we're just over 30, and then the rest is smaller cap stocks. We'll keep going because I want to leave time.
I was going to say, does having the closed-end fund structure make it easier to invest in these smaller stocks?
Yes, it does, James. Yes, that's right. So that sort of lack of worry about inflows and outflows is a permanent capital structure, it's called in the sort of technical language, and closed ends. And I know, Andrew, I've spoken to Andrew before about this, but those people who know investment trusts, and you know them better than most, I mean, you can see this. It's that vehicle that means that actually at times like this, I'm not having to, I'm in regular dialogue with the directors, but the one thing we all agree on is actually at times like this, it's a great time for investment trusts, the closed-end structure to shine. And and I think there will be these redemptions out of funds that, in particular, I think we've started to see it actually in quality growth funds, because you can see that actually you've seen the headlines, as I have, about how really the top 10 best sellers from last year are now starting to see outflows, and that was happening before Ukraine. So you can see that actually initially it's profit taking, isn't it? But then that money's got to go somewhere. So in terms of, I look at the open-ended sector and I think to myself, actually that's, if this shift away from quality growth and tech stocks and so on, and you just mentioned the Polar Capital Financial Fund, and actually, as you mentioned, about 35% of this portfolio is financials, and it's been it's been a curse for some time owning financials, because when bond yields were falling, nobody was interested. But what you find is that these big swings in fund flows on the open-ended side tend to have a pronounced effect on share prices. So I'm sure we all look at the same stocks in the States. The ARC Innovation ETF is worth looking at, because that gives you an indication of quite how aggressive the selling is in blue sky tech. We've got our own versions of that in the UK market. And what's interesting, I think, James, as well, in the last couple of weeks is what the question about what is defensive. Actually, if we move on to the next slide, I'll show you. So here you can see, 44% of our portfolio generates its revenues from the UK, and that's the biggest area geographically. And on the right hand side, you can see that 34%, as I said, is financials in terms of our sector exposure. And then after that, we've got large weightings in consumer discretionary. I'll tell you why. That's a bit counter-consensual at the moment, actually. And then the green is mining, which is materials, and then we've got energy as 10. So actually, if you add up all those three sectors, that's roughly 3/4 of the portfolio, and the rest is other stocks in different sectors. But 3/4 of the portfolio is those three sectors. And I think, just going back to the point I was making earlier, that actually this sort of fund flow out of tech and out of quality growth, what you found in the last 2 weeks has been bond yields. If you look at real bond yields anyway, getting into the weeds here with the bond market, but it's worth being aware that actually real yields have started to fall a bit. So that as those people who've been following this will know that actually that move in bond yields has been a key driver of value versus growth for some time. And it's actually real bond yields rather than nominal bond yields that drive this. So real bond yields were at -1% in the States. 10-year US real bond yields were about -1% for much of last year. And then this year in January, they spiked to -40 basis points. And they're back now down to -90 basis points, so -0.9. Now, what's interesting, so we've done a round trip. What's interesting is that the quality growth stocks are not benefiting on the way back down. So that move from -40 to -90 has not coincided with the outperformance of tech stocks or quality growth stocks. Now, why is that? Well, inflation is, if anything, going up more than it was before. This Ukrainian situation is just feeding inflation further. Supply chains are even more broken than they were. Deglobalization is happening at an even faster pace than it was. That is inflationary. So for me, this is quite an interesting moment where correlations are beginning to break down. And this is an uncomfortable situation for people who are heavy in quality growth stocks or tech stocks, because actually they may have had an inkling that it was the right thing to be doing to take some profits in those areas, which have been phenomenally strong for the last 3 years. But now they're seeing, in real time that actually it's not working, and it's not. And so as those of you who've seen different sort of market moves in the last 20 or 30 years, you will know that often the mega theme that works for years stops working, and then it doesn't go back to that same mega theme. So this is what's interesting to me, is that what's the new mega theme? And I'm wondering if it's actually inflation. So if we move on, just a bit more, James, I'll try and speed up a bit. But so I mean, this is again, sorry, this is the bit that is at risk of sounding a bit salesy. But for me, that AIC icon at the top right is Dividend Hero. We only got it last year. We're 21 years now into growing our dividends, and I do not want to be the fund manager who breaks that 21-year track record. The dividend yield was 6%. Last year we didn't quite cover it with earnings, so we did 20.1 in the year to September 21 versus paying out 21.2. This year the board have said they've got reasons to believe that they should be rather confident that we will. So if you listen to our webcast, you'll see, the language from my chairman is far more confident than it was a year ago, and that's because I'm showing him the revenue account month by month, and that he is seeing the progress that we're making. And so, in fact, we're sounding more and more confident every time we update the market on our ability to cover that dividend. And the Ukraine situation does not alter that. Given my sector exposure, given those basic materials, given those oil companies that we own, and the dividend outlook, if anything, has strengthened, despite selling those Russian stakes, or not selling, I should say, exiting those Russian stakes, because it's uncertain whether they'll get any money for them. But actually, despite that, the tightening in gas markets and oil markets globally is going to have a profound effect on the cash flows of these companies in a positive manner. So the inflation that we're seeing is going to have a positive impact on interest income, because it will drive higher bond yields and higher interest rates. So for the financials, so I do think, absolutely alert to the risks at the moment that we enter some kind of stagflationary situation as this big global slump. But this is the moment to be seizing those opportunities, and just as you discussed in the first half of this call. So I want to keep that dividend growth positive. Now, if we move on again, just so that I wrap up with a couple of slides. So this is one stock. Now, you may think, well, how strange if somebody's talking about being index agnostic, and then he chooses the one company that's over 6% of the index and largest stock in the FTSE. That's a bit odd, but it's really to show you that we look for high conviction ideas across the market cap spectrum, and this includes mega caps. So at the moment, you don't want to own all the mega caps, but having some Shell in your portfolio is not going to do you too much harm. And so, I was just checking the up-to-date free cash flow yield as forecast by the analysts on on the sell side, you know, the analysts who have updated their models for the latest moves and exiting the Russian assets have got a 16.8% free cash flow yield for next year, 14.4% free cash flow yield for this year. So that's the level of cash flow that's available to shareholders after all of the maintenance, capex, and fixed costs that are paid. And that is what's left over. Now, if you think about that, they're not paying anything like that out in dividends. They're only paying a dividend yield of, let's say, you know, what is it, 4%. It is a growing dividend now, of course, after the rebasing in the pandemic. But if you think about that, that leaves them with around about 10% to play with. And what they're doing is they're de-gearing the balance sheet. So the balance sheet, the net debt to EBITDA is going from around 1x a few years ago to, you know, quite quickly down below 0.5x. So the gearing ratio is falling. They are embedding that credit rating with the agency, so their cost of funding is going to be lower because they can have a better credit rating. They're going to find that they can do share buybacks, which is obviously flexible, and we're seeing that with banks as well, that they don't want to get into a situation where they have to cut the dividends again. So they're doing more buybacks now at the margin, less dividends. So that's okay. We can still achieve that 6% dividend yield that you saw on the previous slide without companies paying everything out in dividends. So yes, it's feeling like a great time to be owning these big oil stocks. And as I said, you know, the Russian news is not good optically to see that news, you know, on the screen. You never like seeing companies saying we're taking an accounting charge, you know, write down for those assets. But these are enormous companies, and we're talking about low single digits hit to cash flows. From the, you know, for example, Rosneft is about 5% hit to cash flows, and that was a stake. So they're not having to get out of the country; they're just having to write off that stake. Shell, the hit's about 2 to 3%. But just think about the impact on their cash flows of tightening oil and gas markets. You know, and the fact that now, and I won't get into ESG too much now, but I do think it's worth saying everybody's perception of ESG in the last month has changed more than it has in the last 5 years. So let's be honest, you know, there was a lot of moralizing about we will invest in this sector, we won't invest in this sector. You know, I was even hearing people saying they wouldn't invest in defense. Well, how relevant is defense now that we've got somebody halfway around the world with his finger not that far from the button? Do we want defense companies to be listed so that we can have that strong say in stewarding them and holding them to account, or are we going to let them drift off into the private sector, where we won't have any accountability at all over them? So actually, look, I think we engage with all these companies, and so for me, a company like Shell has got a huge role to play in, you know, decarbonising the world in the next 10 years. But let's be honest, it's not happening overnight. You know, that actually at the moment, 85% of UK homes use gas, and that gas comes largely from Norway, and it's about 40% from Norway. Less than a third of it comes domestically, which is, by the way, the lowest carbon form of gas is domestic gas. The rest of it comes from LNG. We've got ourselves into this situation. You know, it's not as bad as the German situation. Germany is, you know, Gerhard Schroeder and so on the Gazprom board, not comfortable. But yes, Shell can play an important role in helping to actually provide energy solution while we decarbonize the world economy. So if we move on again, so I think this is my last slide, I think, James. So yeah, this is just to say, you know, where are we positioned? So I think I've talked a lot about financials already. I would say that big banks have been a lot better than the other financials. So if you get other fund managers who are focused on financials, you'll have heard this, that the big banks are really the most obvious play on higher inflation and higher bond yields, because their P&L is mechanically geared to higher asset, what they call higher asset pricing, which is mortgages, business loans, etc. So that's what they call the asset side of their businesses. And of course, the deposit side, the liability side, which is the deposit side of their business, is being held down because there's plentiful deposits. And that's another reason, by the way, this is a sales plug, but that's another reason why you have to look at income, because, you know, have a look at the level of deposits in the UK economy, and then go and ask yourself, given how flush the banks are with deposits, why would they raise deposit rates? You know, sure, there'll be 10, 20 basis points here and there from some of the banks that need funding, but the big banks are rolling in deposits. They do not need to raise the rate that they pay you on your deposit accounts, even the term deposit accounts, let alone the current accounts. So look, banks are the clearest play, but when this period of geopolitical uncertainty is over, you need to make sure that you're also looking at the smaller cap stocks, you know, the lenders, there are some great self-help stories in this sector, actually. So the resources speaks for itself, is just, you know, the clear beneficiary of inflation at the moment. I don't think I need to go into that any further, but I mean, obviously we've had statements from each of them in the last few weeks. If you think about Glencore's trading business, that they call it marketing, you know, Glencore moves stuff around the world, and they find they're the intermediary. They're a bit of a broker, really, between buyers and sellers. You know, what as you know, all these brokers, they thrive on volatility, and they thrive on sharp price moves, because they can then connect buyers and sellers and take a turn. So I wouldn't be at all surprised if Glencore's trading profits, marketing profits, soar in the next few months. So they are particularly well positioned. They also have copper, all these sort of, I mean, a lot of people don't know that, of course, Russia's a major producer of copper. So cutting Russia off is going to have a profound effect on the copper market in terms of demand and supply. And then the dirty word coal, Glencore have not sold their coal, unlike Anglos. So, and you can imagine what effect cutting off Russia has had on the coal price. It's soared in the last few weeks. Consumer is the more controversial area, and of course we need to be careful short term, because this is going to have a detrimental impact on household cash flows. But I did one of the bullets on this slide. I put that household savings ratio, so the percentage of the household income that's saved has been over 8% for the last 6 consecutive quarters. Now, obviously, a lot of that is the lockdown benefit of people not commuting into London, etc. All this, the obvious reasons why we've tended as a nation to save. Now, that's been very mixed from one end of the socio-economic spectrum to the other. Some people have benefited more than others. But in the back of my mind, when I see these consumer stocks being hit by short-term worries about the higher gasoline prices, or petrol, diesel prices at pumps, and higher energy prices, where the government's going to sort of think very hard about how they can offset those energy prices. In the back of my mind is actually there's a huge amount of savings that has built up in the last 2 years during COVID, which are sitting there, and goods spending has held up quite well, but services spending is not. So people will come back and spend money, and they will go on holidays again eventually, and they will. And so within consumer, I'm thinking about how to make sure that we're ready for that moment when we get that lift off in the consumer. And of course, house building is continuing. There's some great statements out recently. This Vistry, which is our biggest holding in the house building sector, that's had a cracking statement just in the last few days. So I'm going to I'm going to wrap up. I think we'll finish on this slide, James, and I think I mean hand back to you, but that's how I'm seeing things. And yeah, no, this is a good time to make sure you're remaining active, remaining thoughtful about what's coming next. Clearly very upsetting scenes every night on the news, particularly because it's so close to home. This is obviously feeling extremely meaningful to us in Europe, but of course in the States, be prepared that most people hadn't particularly heard of Ukraine or particularly know where Ukraine is. If you gave them a map, they wouldn't be able to say Ukraine is here. If you're sitting in somewhere in the Midwest, you're probably not as preoccupied by it. And I think I say that not because it's sort of a heartless thing to say, but because actually the impact on consumer sentiment over in the States is likely to be relatively limited. The impact will come through in the gasoline prices, sure, but remember that the US does have a surplus, and therefore in terms of oil and gas, they're exporters now, so that will cushion them to a large extent. If you look at Henry Hub, the gas price in the States, it's not really moved because they've got a lot of gas landlocked. They're only just starting to build export terminals for liquid natural gas. So I'll hand back, but fascinating times, aren't they?
Yeah, definitely. No, thanks very much for that. I think that wraps up an awful lot of stuff that you need to think about. One question here: what have you been doing with gearing?
Yeah, well, gearing is 13% at the moment on this trust, so I am still happy with that. And short term, we had a back and forth last week. This week it's been mostly the stock market falling. It's very difficult at this stage. If you look at sort of the history of conflicts, you would be surprised how soon after the beginning of a conflict stock market finds the bottom. So as uncomfortable as it feels right now, it's quite possible that we will look back on March 2022 in a few months' time and say, why wasn't I buying in March 2022? And actually, I've said that for every stock that's under a bit of pressure at the moment, you can build a case for a fair proportion of the UK stock market that things are in pretty good shape. And I'm not just talking about resources here or financials. I think there's other sectors which are going to thrive even despite this negative news flow. So we do talk about it. The directors challenge me on gearing. At the moment, my thinking is keep the gearing so that we have got a little bit of cash spare, so that you can deploy it. And today is a case in point. The stock market, I think today on Friday, the 4th of March, is down 3%. Well, probably not the day to be, reducing the overdraft facility, and so at the moment, the thing we're thinking is just making sure that we've got a little bit of cash on the sidelines to invest incrementally where we see opportunities, but not to make some big asset allocation calls on when the market will bottom.
Fair enough. Thinking about the UK relative to the rest of the world, I mean, there's still the question here, so I mentioned this Brexit, but what's your kind of view on the outlook for the UK economy relative to, say, US and North America?
Yeah, I mean, I think I mentioned just now that I think the further you are away from Ukraine geographically, the less likely it's going to have a major impact on your economy. So the US is looking like it's in a better position from a consumer cash flows perspective. Partly that point I made at the end of the presentation about how much energy self-sufficiency the US has now over the last few years. That's built up. What I think we will see in the UK is, we're going to have headwinds, particularly during the winter, the last month or so of winter now, that actually we know what the price hikes are going to be in April. The next hikes after that in terms of gas and electricity will come in October. So the government's got quite a lot of time to think about how does it mitigate that. And that may take the form of some kind of subsidy or some kind of loan. We saw that, £200. I mean, that doesn't feel like it's the last we've heard of that. Petrol prices are going up, so people will either drive less or that will come out of their disposable income. Although it's worth saying that for every $10 the oil price goes up, the petrol price only goes up by about 5p, because most of it's taxes, as we know. So look, I think it's easy to get gloomy about the consumer, but in the UK, but actually, look, we're not Germany, and I do think what's interesting at the moment is there's obviously lots of discussion about sanctions, and whether you believed in Brexit or not. Actually, what's interesting now is the UK can make decisions now, on really important areas, and thinking about what's right for Britain, and it's going to be interesting to see. I mean, I think this news flow, this geopolitics it really has changed the agenda, hasn't it? Because if we were having this call 3 months ago, we'd be talking about Partygate, and we'd be talking about COVID, who's wearing masks and who's testing and all this stuff. And it's actually put it all into perspective, hasn't it? That actually, and even Brexit, I think, until recently we were still talking about Brexit, and I see that Article 16 talks have been pushed to the right by another 6 months now. That was news overnight. So look, I think the UK can make its own decisions, and actually when you think really about the basics of where to invest, I think what Russia has shown you is the rule of law is incredibly important. And actually, why does money flow into countries like the UK and Switzerland? Well, it's partly because of the rule of law. So I think that actually, that the idea that now the world is bifurcating, between this dictatorships and liberal democracies, the UK can shine again. Clearly, there's work to be done on how to make Brexit work, but I'm bullish on the UK. I think the UK's got a great future the next 5 to 10 years. There's just got to work through the detail now of how we can thrive in the economy.
Exactly. But just to make some, because there was some confusion, that this chart is looking at where the revenue is coming from for the companies that you hold. It's not where the companies are listed. So you're still very much a UK fund.
Exactly, James. I thought that we were discussing how best to word this, and it may be that we still haven't quite cracked the wording, but I think that's right. So what we've done is the companies in their annual report produce geographical splits. Then we aggregate that. So it's not Aberdeen Standard Equity Income Trust's revenues. It's the revenues of the underlying companies. So in other words, at the moment, one of the discussions we've been having this week is there are a handful of companies with Russian exposure in the portfolio. So, for example, Mundi is a paper company with operations in Russia. It's just under 10% of their revenues, so it will have an impact. The shares are down a lot more than that. And so that's one of the stocks we've been discussing. And so, we go through this. I mean, it's interesting, actually, that's having an impact. I should say, actually, talking about what is defensive, which is a very interesting, movable feast at the moment. The tobacco companies have stopped performing in the last few weeks, in the last 2 or 3 weeks. And that's, again, they've got Russia. If you look at, some of those beverage companies, again, trading in Russia, that's having an impact. Some of these wonder stocks like Watches of Switzerland have started to crack. So it's fascinating, that actually stocks you thought were only ever, benefit from an environment like this have started to turn. So it's making it very challenging. But I think, you know, ultimately, you know, having some BAE, you know, as you know, as I said, 6 months ago, we were seeing sell-side analysts, brokers, writing off a name like BAE Systems on the basis that it was in the wrong sector, and from an ESG perspective, it was indefensible. I mean, it's just, it really beggars belief now when you think about what's happening in the world, that, you know, how could we write off a company that's integral to not just our defence, but the defence of NATO, and so I think that really has sort of changed people's priorities, and it's put ESG in a sharp focus. You know, that people talk about the greening of brown investments, and we need to play a role, you know, throughout all of this in guiding companies, stewarding them, and helping them to, you know, to move in the right direction on these long-term issues like net zero. But in the meantime, we've got a war and we've got an energy shortage. So let's just be clear about, you know, where in the agenda, you know, and the timeline of that agenda. You know, right now, cost of living is incredibly important to people, and so is energy security, and also making sure that we defend ourselves as a country in a very worrying time.
Thanks very much, Tom. Really interesting, actually. I think we covered a lot of ground there. So we'll catch up with you again in a few months' time, perhaps.
That would be great.
Cool.
Thank you.
All right. So things plough on. We've got our the third day of our Around the World webinars next week, and that will be Asia. Me in the chair, I think. And then I'll be talking to James Harris of Securities Trust of Scotland next week on the show. And we're still at Master Investors coming up, and we've been sort of refilling the hopper a bit in terms of the managers. So we can see what's coming up there. If we didn't ask your question today, apologies. Not a lot of stuff to get through, but I'm sure we'd be happy to try again next week if you pose a question again. So hopefully we'll see you again soon. Have a good week. Bye-bye.